time to connect with a global guest, help understand what the implication of this tariff agenda, the back and forth that we've seen on the tariff front is going to be. Let's welcome on board Ed Yardeni, the President and Chief Investment Strategist at Yardeni Research. And Ed, good morning, and once again, great to be speaking with you this morning. Help us make sense of how the markets are going to read into this volatility that is the tariff action coming in from Donald Trump. Because on one hand, you have him aggressively imposing tariffs, then he's withdrawing all of these tariffs that he's imposed, most of it rather, on Mexico as well as Canada. The global impact we've seen has been really bad for Wall Street. How do you believe it's going to pan out for other global markets today?
Well, I think we're all buying neck braces. You know, it's kind of been head spinning. Everybody's head is spinning. The volatility is clearly coming from Washington, clearly coming from the White House. The president seems to change his mind quite a bit, and that's adding to the volatility. I think at some point here, the markets may actually start to tune out the statements coming out of the White House and just focus on the fundamentals. Right now, that's hard to do, but I do think that the underlying outlook for earnings is still good. We'll see. We'll see tomorrow. We're going to get the employment report here in the United States Friday morning, and I'm thinking that it could surprise us to the upside because the January numbers were depressed by the coldest January since 1988. So I'm thinking that we may get some relief from the economic indicators showing that the economy is actually still quite resilient. Maybe it's more wishful thinking than likely to happen. But again, I think there is some good fundamental reasons to believe that the weather-related weakness in January will be reversed in February and March. What I don't know is what statement will come out of the White House next.
Just focused on what the U.S. Commerce Secretary is saying. I mean, he's talking about the market volatility and he's saying that's not really the driving force behind their decisions, sort of backing Trump's tariff imposition. He's saying that the, administration is focused on rebuilding America. Other than that, he's saying that you are going to see growth and interest rates drop either 1% or more. Do you think that's where the central bank is headed?
No, I don't think the Federal Reserve is, at this point, even thinking about lowering interest rates. They may change their mind depending on what Friday's employment report does. But I'm thinking that the economy has been remarkably resilient over the past 3 years in the face of the tightening of monetary policy by the Fed. I think the Fed is going to maintain its independence. I think it will be driven by the data. And if I'm right, and the economy proves its resilience, then I don't think the Fed's going to be in any rush to lower interest rates. And besides, the administration, the Treasury Secretary said that they're really focusing more on the bond market, and they really don't have much control over the bond market. As a matter of fact, we've seen this, although the bond yield has come down a lot over the past day or two, it's actually gone right back up to about a little over 4.25%. And I think it's probably going to go back up some more. We're still going to have a lot of potential turmoil in Washington, D.C. over the budget over the next few weeks. So Washington is going to create volatility, but the economy, I think, is going to remain remarkably steady.
But also help us understand that what is the outlook on the bond market, because just yesterday what we have seen is that the Germans did come out with their big spending plan, and that made the bond markets over there shooting up. We have seen the Japanese bond market hitting its 16-year high. Do you believe that once again we should be in for a regime where globally, of course, there will be some uptick within the bond market?
Yeah, it's interesting. We have what looks like a trade war one day, and the next day it's postponed for a month. But if there's anything positive coming out of the Washington policy turmoil right now, I think the message is quite clear to Germany and other Europeans that they really have to start doing more for themselves on defense, and they have to do more to stimulate their economy. And that means deficit financing in Germany, more deficit financing, and that's pushing bond yields up over there. And at the same time, we've seen the Chinese move to provide more stimulus to their consumers. So ironically, we may actually see better economic growth rather than weaker economic growth. Though again, there's a lot of uncertainty about where this trade war is going, if anywhere. And I do think that is putting upward pressure on the bond market.
It sure is. Ed, so good chatting with you today. Thank you so much for your time.
My pleasure. Thank you.
If you like this video, then like, share and subscribe to ET Now.